this is the first committee session where we've welcomed our new members, and for public benefit, their register of interests is out there in the public domain, and if any of them are relevant to the questions that they're going to be asking you, they will declare those interests at that time. Right, well, you've had an unpredictable summer, I think it's fair to say, Richard, and you had presumably thought that you might be invited to prepare your economic outlook over the summer. From your personal point of view, how was that expressed to you? When were you first told that your services were not going to be required?
Yes, it has been an unusual process leading up to this moment. When the leadership election for leadership of the Conservative Party and selection of a new Prime Minister was initiated, we approached the Treasury and had a discussion about our expectation that a new Prime Minister and a new Chancellor would need an updated forecast from us to make whatever fiscal decisions they wanted to make. We made that approach in late July and by mutual agreement with the Treasury set in train the process for preparing an updated forecast. We thought that was particularly important because there had been some big movements in forecast determinants since our last forecast back in March. In particular, gas prices had started rising and then kept rising through the summer. Interest rates also started to rise over the course of the summer, and then again, the momentum picked up through August.
So you worked on it throughout the summer?
We did, although our initial deadline was to make sure that it was ready for the new Chancellor to be on his desk at the time of his appointment in early September. And by the time Kwasi Kwarteng arrived in the Treasury in early September, he had an updated forecast from us on his desk.
So it reached his desk, and then when were you told that it wasn't going to be published? So
we were informed shortly after that. The precise date is in the forward to the document, but my recollection was it was at the end of that week we were informed that he was not going to request a forecast from us to accompany any fiscal statements he was going to make later on in the month.
And what you have published now is obviously quite a bit shorter than what you have typically done. What have you left out?
So it is shorter than our usual forecast. It's just over 60 pages, whereas our typical EFO is well over 200. There are some people who've liked the new shorter format. It's more concise, more readable. I think there are others, and Anthony's nodding his head, but there are others who have missed some things. The reason it was shorter was that we were in essence having to maintain a constant state of readiness to publish a forecast. We had 3 different deadlines throughout the process, two of which were moved forward. So we had to be prepared to, keep iterating on the forecast and publish it at relatively short notice. That meant that our time to write it up was more limited. It is a shorter document. We've made sure we satisfied all the legal requirements of an EFO set out by Parliament and legislation. It has meant that we've gone into less detail on aspects of the forecast than we usually would. In particular, there's not the long annex on policy measures that you would usually see in an EFO. We've had to keep that shorter and more summary. There's fewer boxes. This time around, we only had 4 boxes going sort of in-depth into analysis. Ordinarily, we'd have sort of over 10, sometimes in an EFO, going into different issues. So there's less. We haven't had as much of a chance to explain our logic around key analytical questions, nor explore some of the policies in depth. And I should really emphasise, this is not necessarily the new normal. We really want to get feedback from yourselves in particular, but also other users of our documents about whether they welcome a more concise product or whether they miss all the content that they used to have before.
I mean, I think this committee's been consistent over the summer asking for your forecast to be published alongside what has been referred to obviously as a mini budget, but obviously was quite major in terms of some of the measures in it in September. And as I understand it, you mentioned the legal situation. You're required to publish one of your forecasts alongside a budget, and that's why these euphemistic terms of mini budget and fiscal event have entered our language to prevent you from actually publishing your document alongside it. So do you think we in this committee and in Parliament should be changing some of the legal language to make sure that major changes to tax and spend in this country are accompanied by one of your forecasts?
I think it is a good principle of fiscal policy making that major fiscal decisions should be based upon and presented alongside a latest and up-to-date view of the economic outlook.
And did your lawyers advise that it's the word budget that is the key thing?
They did, and the law says that we have to publish 2 forecasts a year, and one of them has to accompany the budget. But the law also says that it is for the Chancellor to decide when our forecasts are published. And it was for that reason that, despite the fact that we had forecasts ready at the time, because the Chancellor did not ask us to publish them, they remain confidential advice to ministers.
Thank you. And in terms of the forecasts themselves, and we all accept that no forecast is ever going to be perfect, a prediction of what happens in the future. And what you're looking at really are the risks around the prediction that you put in for the future. It is very noticeable, however, that your forecast is very different from the Bank of England's forecast. And I just wondered if you could talk us through what you think are the major differences in assumption that you've taken there.
Sure, it is different from that set out by the Bank of England, although I should emphasise the Bank of England actually set out 2 forecasts in its monetary policy report. So it's different from the central one, which of theirs, which was based on the market assumptions for the future bank rate. It is more optimistic for the growth outlook than the bank's forecast. We have a shorter recession, and we recover to a higher level for GDP than the bank. I should emphasise, however, that it's more or less in line with the forecasts of other independent forecasters. So we're quite close to the consensus. Is actually the bank, which is a bit of an outlier in being so pessimistic, in particular about the length of the recession that we both think has already begun. Going into the reasons for why our forecasts differ, it's really 3 things. One is the vintage of data that we took in this forecast versus the one done by the bank a few days earlier. We took a slightly later vintage of both gas prices and interest rate expectations. Those had been coming down over the course of late October and early November, and the later you went, the more you sort of got the benefit of those, both gas prices being slightly lower and interest rates being slightly lower. A second important reason comes down to a difference of judgment, which is around the savings rate and what will happen to the household savings rate in response to this unprecedented kind of once in a century shock to living standards. And that is that we think that the savings rate is going to fall over the course of the next few years, or over the course of the next year, as people dip into their pandemic savings to support their consumption over the course of the next few quarters. The bank think the savings rate is going to go up because people are holding on to more precautionary savings because they're worried about the outlook for their incomes and their employment. We will see who's right, but I think given that this is an unprecedented shock, we thought it was not unreasonable to think that people might do.
Is that purely a judgment call? There's no actual evidence base to make either of those 2 assumptions?
Oh, it's based on the models that we have,
okay.
And David might want to say a bit more about it. But it's something which we've seen unprecedentedly high savings rates in the recent past, and when people had maintained incomes but weren't able to spend the money, given this is an unprecedented shock to their earnings, we thought that it was not unreasonable to assume that they might dip into some of those savings to support their consumption when their earnings.
No, it'd be interesting to hear from David on that, and also on the assumptions that have been made about the drivers of inflation. And is it correct that all the forecasters seem to be saying that inflation will come down by the middle of next year? I think you've got inflation of about 7% for the year as a whole. Can you talk us through some of those assumptions as well?
Very briefly, thank you. On the savings rate, I think such is the hit to disposable income of households that it seemed to us plausible, and economic theory would suggest there's something in this, that faced with such a fall in purchasing power, which recovers a little bit further down the road, it seemed likely that people might dip into savings. Added to the fact that, in aggregate anyway, the household sector in the UK, largely a result of the lockdowns in 2020, 2021, accumulated a really large amount of what you might call excess savings that couldn't be explained other than that people were constrained in being able to spend money. And that was of an order of £18 billion or so. So it's a big number, and we assume those that can dip into that, those that haven't got accumulated savings are in a more difficult position, but they may be able to extend mortgages a bit and use credit cards and such. We assume that the aggregate impact of that is actually to take the savings rate to pretty much to zero.
But did you have any evidence base for that? Did you do any survey work? I mean, what would underpin your work compared to the bank's work on that?
I mean, there is some survey evidence. People ask, how are you going to deal with higher energy prices and other prices? And a significant proportion not a majority, but something from recollection, maybe 30-40%, say they will dip into savings if they can. So we assume that obviously not everybody is able to do that, but a significant portion are. I think just in a longer term context, there's a huge amount of empirical evidence gathered over many years that temporary reductions in disposable income tend to be matched by a lower savings rate, to some extent anyway. So we used both those ideas really and took the savings rate down materially more than the Bank of England. I think that's the most significant factor.
So then the obvious follow-up question to that is that does that mean that the risks to your forecast are much more to the downside than the banks? I'm not sure about that, because if you look at what happened to the savings rate in 2020, 2021, I think it got up to something like 25%. That's an extraordinarily high savings rate. We go down to zero, essentially, in this forecast for a short while. Zero is about maybe 5% below what you might call normal or average over the last 10, 20 years, whereas 25% is massively in excess of it. So in some sense, we're only allowing for some relatively small proportion of the excess savings to be run down. And I think it may well be the case that the total savings rate for the household sector is even lower than our forecast. So I don't think all the risks are on one side. And then to my questions about inflation, then what are the assumptions there?
I think the key factor, in a sense, is the partial unwind anyway, of what has driven inflation, or the primary factor that's driven inflation up so much, which is the increase in energy prices, gas in particular. We use the market forward rates, which in some sense are a market expectation about where energy prices might go, and we use the forward rates over the next 3 years. And what they would imply, if things turned out in line with those market expectations, is that there's a really substantial fall in energy prices, particularly gas prices, really starting relatively early next year, but accelerating really sharply as you go through 2024 into 2025. Even if energy prices didn't fall but just stayed where they were, because the rate of increase would become very small as you go into the future if they just stayed flat. That in itself would very likely have brought the inflation rate down a lot. But as I say, those forward rates imply that energy prices actually fall very substantially, something like 30-40% between the middle of next year and toward the end of 2024. And that is the single most significant factor in driving inflation down really quite sharply in our forecast. It actually takes it slightly negative once you get into 2025, before then moving back up again.
Okay, turning to business investment, you're pretty gloomy about business investment overall, and you don't really seem to think that any of the measures that the Chancellor announced, the annual investment allowance, for example, you don't seem to assume that they're going to have a massive impact on business investment.
No, and business investment has been pretty disappointing for a while in the UK, and with a shock to household incomes, a shock to consumption, business investment tends to track expectations of future consumption. So at least in the near term, given that we're forecasting a consumption-driven recession, it's unlikely that you're going to see lots of businesses investing into a recession. You've also got on top of that an increase in the economy-wide cost of capital from the fact that interest rates have started to rise. And that means it's going to be harder for businesses to raise finance if they want to do investment, and the hurdle rate for those investments goes up at the same time as your expectations of future sales are going down. And the government now is going ahead with the corporation tax rises. So had they not done that, that would have provided some support to investment over the course of our forecast. But as that measure's now going ahead and the corporation tax rise goes up, that further reduces the post-tax return on investment. So all of that for the period that we're looking at means that business investment sort of stagnates for a few years before it starts to pick up toward the end of the forecast period as the economy recovers, and also interest rates start to come down a bit, at least at the short term.
And is it too early to say what the impact of the super deduction for investment, which was designed to prevent sort of people waiting until corporation taxes went up to invest? Is it too early to say if that's had an impact?
It's a bit too early to say because it doesn't close until April, I believe. So it's still got a few months to run. When we last looked at it compared to our original estimates, we'd overestimated take up and how much investment it was going to stimulate. It probably stands to reason, given all the uncertainty around the economic outlook that's now been created by both higher energy prices and higher interest rates, that increases the headwinds that it would have to get over in order to incentivize further investment. But it's not been enough for us to make a material difference to our estimate of the kind of overall final size of the capital stock and levels of investment over the forecast period, which means that for us it doesn't have a big impact on long-term growth.
So any other points to make on why your forecasts are so different from the banks?
Let me just raise one final thing. I said there were three things. One was the vintage of data. The second was the savings rate. The third is that our final kind of steady state growth rate for the economy in the medium term is higher than the banks. We assume that in the long run, our potential output grows by 1.75%. The bank have a sort of trend growth rate of 1.5%. So our economy after the recession is recovering to a higher level, a higher rate of growth in the long run than the banks.
And what's the underlying reason for that?
It's a number of things. It's partly assumptions about labour force. It's mostly assumptions about the pace of technology growth, whereas you could describe the bank as a bit more sort of techno-pessimists compared to us. We think that the rate of growth in technological innovation goes back to somewhere between its pre-financial crisis and its post-financial crisis average, whereas the bank believes that the financial crisis was more of an augur of just a lower level of innovation going on in the world than we do.
Okay. John, you had a quick question on economic growth.
Just very briefly, can I just press you on your optimistic growth forecasts? I mean, just withdrawing from the detail a little bit, if you look back at history, previous periods of rising interest rates, high government spending, taxes rising, and living standards falling, traditionally that's been a mix for slower economic growth, not optimistic bands. I mean, why is it different this time?
I think we would say it's different. The main reason is that I think the period you were describing were perhaps the energy shocks of the late 70s and early 80s. Those shocks lasted much longer than, if you believe what the markets are saying about the futures price of energy, this shock is going to last. They've got energy prices coming back down quite dramatically, as David was saying, over the course of next year, which provides some relief to the economy and makes this more of a temporary shock in terms of where we started to the peak. Now it is the case that energy prices, gas prices in particular, still remain much higher over the medium term than they were pre-pandemic. But the economy is already getting some relief over the course of next year from falling gas prices, compared to the energy shocks of the 70s and 80s, where the oil price went up and just stayed high for years, and that acted as a drag on economies. And also, I mean, one could argue that monetary policy was further behind in catching up and in reining in inflationary expectations, which also acted as a drag on growth and investment over that period. So I think it's for that reason that we think that this would be, we've got a 5-quarter recession that's of a reasonable duration, but it's not like the sort of stagflationary periods that other economies have suffered when they've had big energy shocks.
Thank you.
Can I follow? No.
Yeah.
Very briefly, you mentioned that you're sort of techno-optimists compared to the bank. I mean, would you accept that despite all the technology prowess of the States, with their big companies there and so forth, and other examples around the world, it hasn't actually significantly boosted productivity or economic growth as far as one can tell?
So I guess all countries have faced a slowdown in their productivity growth, and part of which is seems to be driven by this fact that the rate of technological innovation has slowed. And there are, it's a puzzle for a reason. We don't precisely know why. So, some people surmise that a lot of the innovation in the last decade or so has been about making consumer experiences more enjoyable rather than making our productive lives more productive, and there may even be a tension between those two things. The more diverting your phone is, the less you get done at work. That may be the case. It's something where we have to make a judgment. We've sort of fallen somewhere in between. I think the people who are very pessimistic about the outlook for technological growth and those who think that we're just going to at some point go back to the world we were in the late 90s, early 2000s.
Okay, thank you.
Thanks. Danny, are you ready to go?
Thank you very much. Yeah, I was going to ask some questions about your expectation or the effect of the changes to capital expenditure that the Chancellor announced. We're maintaining the investment that was planned for the next 2 years, but its rate of growth will slow after that. Can you just talk us through what you think the impact on growth will be from that? And there's a follow-up. I'm interested in whether you distinguish between different forms of capital expenditure that the public sector might be making in terms of effect on growth, if the Chancellor still has, or departments have the capacity to make choices within the limits they've been given, are there better and worse investment decisions they can make?
Certainly, I suppose, looking at the sort of long swathe of history, the UK has traditionally been has underinvested from the public sector, from the point of view of public investment. We've net investment was under 2% of GDP back in 2000 and before then, and so we've typically invested less than 2% of GDP as a country in terms of investment coming out of government. More recently, and in particular in the March 2020 budget, the government set plans to increase the public investment a lot, which saw it reach 2.5% of GDP last year. The government's plans over the next 3 years, as you say, are more or less protected, and it stays roughly around those levels. Obviously, GDP is jumping around over the next few years. But from 2025-26 onwards, the government freezes the capital budget for departments in cash terms for the remaining 3 years of the forecast, and that means that the share of public investment in the economy drops from around 2.5 down to something more like 2.2, 2.1 by the end of our forecast period. So it's constant in cash terms, but falling as a share of the economy and falling in real terms. One thing to emphasize about its growth effects is that it takes a very long time for investment decisions to have an impact on the long-run growth rate of the economy. If you just think about how long it takes to build Crossrail, HS2, these are 10, 15, 20-year projects. They don't have any they have a small economic benefit to aggregate demand while they're being built, but the main benefit they get is from putting a new bit of network infrastructure into the economy. You don't get any of that benefit until the project's finished, so you could have to wait 20 years, and you don't get the full benefit until you wait the whole lifetime of the project, and probably also economic activity starts to cluster around it. And so for all of those reasons, you don't get any sort of immediate bang for your buck from public investment. But what you do get is the benefit of building up over time a larger stock of public capital than you would otherwise have had in the form of that network infrastructure. We had assumed that, based on the government's plans back in March of 2020, that increase in public sector net investment, which at the time was programmed in for about 0.7% of GDP, was going to raise the public sector capital stock by about a quarter. So a big increase, it's a 25% increase in the overall stock of public capital by the time it ran its course. And in the period beyond that forecast horizon, that could add 0.1 percentage points to the growth rate of the economy in steady state. Given that the government is paring that back somewhat, although not entirely, that will have an effect, but it would be beyond the forecast horizon for this document. When we do our next 50-year projections, we'll have to think about what it means to have a lower level of investment as the basis for those longer-term projections. But in a given 5-year period, anything government does with public infrastructure doesn't have a big effect on our assessment of growth, because most of those projects barely get started.
No, I do appreciate that, but it sends a signal, doesn't it, which will affect wider sentiment. And you mentioned low business investment, which is a chronic problem in our economy. I mean, is there an evidenced link between public investment and private, and do you think that the decision to slow the growth in public investment might discourage private business investment, which might have a quicker return than these big public infrastructure projects?
It's one of the things that goes into our calculation of the gearing ratio between public investment and overall growth, that it's not just the benefit of people being able to get from one place to another more quickly, but that it also sort of bails in private investment as well. But as I said, only over a very long period, and only if it's sustained. And I think one of the dangers, we always come under pressure to say, why don't you give the government more growth benefit for its investment decisions? And it's partly because those decisions don't get sustained. Governments oftentimes reach for the capital lever as a way of reducing the deficit when they can, And it means that if we base a forecast on an assumption that government is going to maintain a high level of capital spending for the whole 5 years and they don't do it, or then they don't get the growth that we were assuming in the forecast. So we haven't revised down growth to take account of a lower public capital stock because basically the effects are so marginal in a 5-year period. But when we come back to our next set of long-term projections,
and what about the different sorts of capital? I mean, would you prioritise, trains over broadband or? Not
really, and sort of for the reasons that. For the same reasons, which is we don't actually know what the government's going to be spending its money on in 5 years' time. We have a rough sense. There are some projects that have been committed, but in 5 years' time, it could be on hospitals, it could be on trains, it could be on something else.
Okay. One more question. Moving away from just purely capital expenditure, sort of philosophical question for you, really. What is the optimum size of public expenditure? As we read that growth is, despite cuts to budget, departmental budgets, size of expenditure as a proportion of the economy is growing significantly, 39% to 43%. Partly that's because of smaller GDP, and partly it's the cost of borrowing. So this is, in a sense, not kind of real money, but it matters in terms of the share of the productive part of the economy. I mean, what is your sense of the impact of, as it were, the kind of gross tax take on medium and longer term growth? So what would be the optimum size of the government in your view?
So we try and stay out of philosophical questions in the OBR because we're not philosophers. We're forecasters. And
go on.
But it is the case for a country like the UK. We have a tax-funded health service. We have an inflation index pension, and we have a lot of debt. And a lot of what is driving the growth in the size of the state over this forecast, and has actually driven a growth in the size of the state over successive forecasts, has been those three things have been getting much more expensive because interest rates are higher, inflation is higher, and we just have a much higher debt stock than we have been used to. We used to have a 30% debt to GDP ratio in this country. We now have a 100% debt to GDP ratio, and when interest rates triple on that, it just hits government spending very quickly. And so the government has taken some offsetting action by cutting, as we've discussed, capital spending, by reducing the growth rate of departmental current spending. But there was very little it could do. If it wanted to honour its inflation promise on the welfare system, if it wanted to keep servicing its debts, then there was little it could do for those elements of expenditure but try and offset them elsewhere. And it had a fiscal objective to get the deficit below 3% and get debt falling, and that implied the tax burden that we got. We haven't, looking at the individual tax measures, we haven't assumed any long-run drag on the growth rate, basically because you had offsetting effects. You had some tax measures that slightly improved incentives to provide additional labour to the market, and then other tax changes like the freezes to thresholds, which basically dulled those incentives. And we concluded at the end of looking at that it was not, in net terms, a material effect on labour supply.
Thank you.
Thank you, Danny.
Great.
Angela.
Thanks, Chair. You've made it clear to the committee that you had a forecast up and ready that had been updated all the way through summer, up and ready to go. When did you discover that Kwasi Kwarteng and Liz Truss were proposing to deliver their mini budget without using your services? Was it at the very last minute?
No, we were informed, and it's actually set out in the forward to our documents. So we were informed on the 7th of September that the Chancellor was not going to be commissioning a forecast from us to accompany the announcement they were going to make later that month.
And did they give you a reason why, or did they just dispense with your services by letter?
They said that they would commission a forecast from us later in the year, and when they made their announcements on the 23rd of September, they said that they were going to commission a forecast from us by the end of the calendar year.
And did you have any kind of exchange with them about how dangerous doing that might be, given that clearly the so-called growth strategy was a fiscal event?
We had no discussions with the Chancellor or the Prime Minister.
Do you think that there are any...
I was actually prior to the 23rd of September.
Right.
We met with them after
when you met, yeah, that was famously shown walking down Downing Street amidst the rubble. Do you think there are any lessons that you think need to be learned about this episode? Do we need a better definition of budget or fiscal event? Are there some things that might protect your position that Parliament ought to be thinking about in terms of changing legislation?
So the committee in its own reports has commented on the growing tendency in UK fiscal policy making for major policy announcements to happen without forecasts. And
it's almost the budgets have become unmoored from where they used to be, and we've had a sort of trickle of them all the way through the year.
it's true, and I think one can't be too critical of specific instances, because there were cases like in March of 2020, my predecessor had just produced a forecast, and then the pandemic hit. And then shortly after that, Rishi Sunak, when he was Chancellor, announced the furlough scheme. I think it was perfectly legitimate that he needed to move at pace. We then worked very quickly to then produce an updated forecast as the basis for the next round of decision making. But you obviously don't want to wait for us if you've got to get something like the furlough scheme in place when people are facing losing their jobs. But there have been other instances where essentially discretionary fiscal policy decisions have been made without forecasts. The health and social care levy and the health settlement alongside it was an example. And
5 fiscal events since March you detail in your
yes,
report.
And good practice as defined by anyone, not just us, but by international organisations that set standards for these things, would say that you shouldn't make fiscal decisions without them being informed by an up-to-date view of the economic outlook.
I just want to spend a little bit of time talking about the change of fiscal targets and the reduced headroom there. I think since 2010, Conservative Chancellors have broken their fiscal rules 11 times. This autumn statement breaks the fiscal rule that was put into place last November by over, I think, 11.5 billion, you say in your report, and it also breaks the current balance target as well by 8.7 billion. What are your thoughts about moving to a 5-year rolling forecast? And it's been called the manana fiscal rule. Do you think it's useful?
So one thing to say is that it wasn't just all chancellors have ended up breaking their fiscal rules with a few exceptions. Since we first started having them in the late 90s, when they were first set by Gordon Brown.
I remember it well.
And we seem to be moving to a system where fiscal rules are a guide for fiscal policy making at the time, rather than something which ex post you can hold them to account for having met. And that was originally the case when rules were, chancellors were on track to meet their targets, and then they broke them, and then they sort of didn't do anything about it, and then they set a new set of targets after an election. So the timetable for fiscal policy making and the timetable for political decision making weren't particularly well aligned. I do think there's nothing wrong with a system where you use your fiscal rules as a guide for policy making, but it just means that you put a lot of weight on the forecast to tell you whether you're on track, rather than putting weight on the ONS to tell you in outturn data whether you're on track. So
it's more about having a fiscal rule that's attached to a forecast that tells you you're on track, rather than actually looking at the actual outcome, isn't it? And perhaps the longer the fiscal rules take to be judged, 5 years now, an increase of 2 years, the less likely that Chancellor is likely to be around to take the flak for the judgment, surely.
That's right, although I would also stress that we've been through a period of extraordinary volatility in the last few years. We've had a pandemic, we've now got an energy crisis. You would probably need to do some quite perverse things with fiscal policy in order to meet your fiscal targets in those kind of contexts,
sure.
Given what's happening to the economy. So it is probably a right thing to do to reassess what targets you set yourself in light of the new economic outlook. But the other thing that I should say is that if we are in a world where shocks are becoming increasingly frequent and serious, and you are concerned about the level of debt and its affordability, then you need to aim off a lot more for those shocks when they do happen. And it has been a pattern of behaviour of all chancellors that they leave themselves, as they have again with these targets, a few tens of billions of pounds in headroom against a fiscal target in 5 years' time, which is a tiny fraction of our forecast error over that time horizon. And given what we now know about where shocks come from, given what we know about the sensitivity of our public finances to interest rates, to inflation, these are very, very small margins. And if you're serious about actually getting debt down and outturn in 5 years' time, you probably want a lot more than the £9 billion that the Chancellor set aside.
Yeah, it's 0.3% of GDP. But I think a 0.4% increase in interest rates would wipe it out.
Yes.
Yeah, it's Okay, debt interest spending more than doubles in cash terms. from 56.4 billion, which is 2.5% of GDP, last year to peak at 120.4 billion this year, which is nearly 5% of GDP. I think that's the highest since immediately following the Second World War. Who are the main beneficiaries of the debt interest that the government's paying out? Are these bondholders or?
I love that. Well, they're people who own government debt. They are the largest group are people who are people in pension funds and insurance funds. They're the people who have long-term fixed instruments. About a quarter of our debt is now owned abroad, so foreigners are also benefiting from this. Foreign central banks, foreign investors looking for fixed-term investments.
I think we'll be coming to some more questions on this as well, a bit further down the line.
There's a note in the debt stock, inflation-linked bonds have quadrupled from 6% to 22%, and that the bank's quantitative easing operations have reduced the maturity of government debt. In hindsight, could the government or the Bank of England have made decisions which would have reduced the debt interest cost for the government?
So it is the case that one of the reasons why there's such a dramatic increase in debt interest costs in our forecast is two things. One is we've got much more inflation-linked debt than other countries, which means that when inflation goes up, that just increases our borrowing costs immediately, compared to other countries who have more of an opportunity to allow inflation to erode the nominal value of that debt away. It's also the case that one of the side effects of quantitative easing has been that it's shortened the effective maturity of our debt, because the Bank of England's bought up long-term government debt and replaced it with its own short-term interest. And because we consolidate both together when we think about the public sector, it means that the net maturity of our debt has shortened dramatically from about 7 years down to 2. And that just means that any rise in inflation, any rise in interest rates just hits the public finances a lot more quickly, because you're not waiting to refinance very much of your
debt. Do you think this has happened almost by accident? Because it makes the whole situation much more volatile and the prices much more sensitive to changes.
I mean, it is a side effect of monetary policy. I'm not saying it's wrong. I'm not saying it's not necessarily a price worth paying.
I wasn't asking you whether it was wrong.
Well, it's an issue which we've highlighted a lot and been at pains to discuss for many years, and we've talked to this committee about it. And we have highlighted the risks that come from shortening the effective maturity of debt as much as we have. And in this forecast, you've seen the consequences there.
Could I just ask a brief question about fuel duty, which you also highlight in your report, and you point out there's a planned 23% increase in the fuel duty rate, which is due in late March, when the 5% cut, which was temporary, exits, and the assumptions about a fuel duty sort of escalator also come in. The government yesterday in the debate in the House seemed to be saying that this wouldn't be happening. So why is it in your forecasts, and what amount of money would the government have to find if it decided not to go ahead with that hit to fuel duty?
So our forecast is based on government policy which was announced back in March, which was that there was going to be a 5p cut to fuel duty this year, but then it was going to be made up from April of next year, which means that on top of the usual RPI indexation, you would add 5p on top of that. That was a policy. That was the policy as it was set back in March. It was the policy as confirmed by the Treasury when they gave us the policy assumptions to use for this document when we produced it this month. And were the government to not go ahead with that policy, it would mean that it loses around £6 billion from the sort of super indexation of fuel duty from April. That said, hardly any chancellors, since 2010, no chancellor has gone ahead with the planned indexation of fuel duty. When the time comes and they actually have to make the decision, they tend to decide to freeze it. But oftentimes they leave that assumption in there for a period because it makes the forecast look healthier than outturn turns out to be, because if you're faced with the decision come next March, they may make a different one.
So if they do that, just finally, that means that they've got to find another $6 billion for the scorecard to even keep the books in the situation they're in now.
Yes, that's right.
How many billion does it want?
6 billion.
Six, okay.
Thanks very much.
Thank you, Angela. Rushnara.
Thank you. I've got some questions on fiscal consolidation. The Chancellor emphasised in his autumn statement that with under half of the 55 billion consolidation coming from tax and just over half from spending, this is a balanced plan for stability. Looking at the overall picture, what proportion of the government's fiscal consolidation overall would you say comes from tax and spending, and how does this compare with the fiscal consolidation of 2010?
I might ask Andy to come in, given I've been talking a lot.
So there's a few ways of looking at this, because there have been many fiscal events since our last forecast. So in terms of the measures that this Chancellor has announced in the autumn statement, and also the decision not to go ahead with cutting the basic rate of income tax that was announced on the 17th, that in our forecast adds up to 62 billion in the final year.
Can you say that again?
It adds up to 62 billion in the final year of the forecast, which is precisely half and half tax and spending. Mm-hmm. The difference with the Treasury's numbers is they separated out that basic rate income tax measure, so that's why they get the 55 rather than 62, but let's not split hairs. Looking at things relative to policy as it stood in March, so how it has changed our forecasts, the consolidation is worth about £40 billion in the final year, and that's simply because part of this Chancellor's consolidation is to cover the surviving tax cuts from the growth plan, of which the health and social care levy is by far the largest. So that consolidation is about a quarter tax and about 3/4 spending. Perhaps the more pertinent measure is what will happen, rather than considering it relative to a baseline of a different set of policies, what is planned to happen over the next, over the medium term. So if you look at spending and tax relative to where they stood in 2019, spending rises by about 4% of GDP in 8 years, and so does the tax burden. So in that sense, it's an expansion of both state and tax burden over that period. Now, if you compare it back to what happened in 2010, both what was planned over 5 years and I guess what was delivered over about 8 years, the share was about 80% spending and about 20% tax. And also, in a sense, it led to a shrinking of the state and a very, very modest rise in the tax burden through raising VAT.
Okay. We were promised by a few chancellors ago, but I forget which one, that austerity was over. But austerity is clearly back now, from what you said. And the IFS said that the British people have just got a lot poorer. The Bank of England governor, when he came and gave evidence, said that the US obviously has grown by 4.2% since the pandemic. The GDP of the Eurozone countries is 2.1%, and yet the UK economy is 0.7%. It's smaller than at the start of the pandemic. These are very worrying numbers for us. Obviously, he also talks about particular shocks. Paul Johnson talks about own goals. The statement, autumn statement, has stabilised things, perhaps, in the light of the fiasco of the mini-budget, fiasco in your organisation being left out of the loop. How do we get out of this doom loop? What should happen in terms of generating growth, and are the steps that have been taken insufficient to be able to get us out of this hellhole that we're in?
We need to be careful about providing policy advice to either government or this committee, but in terms of what we're currently assuming about the growth outlook and maybe what is holding that back. David, do you want to say a few words?
I think relative to where we were in March, which was not a particularly comfortable position to be in even in March, because energy prices had already gone up quite a bit, and the recovery from the pandemic was being held back slightly by a much lower labour supply than we thought. So even in March, things were not tremendously optimistic in terms of the outlook. But the things that have really happened since then, I think, explain the scale of the shock to the population in the UK, and they are increases in interest rates of a scale that simply wasn't on the cards back in March, and a further but very large increase in energy prices. So if it,
And just on the increase in interest rates,
yes,
you're referring to what happened in September and having a material impact. Obviously, we've had the monthly increase anyway before September.
Yes,
Could you just
yes, absolutely
separate the two out and explain?
What happened in September was an increase. There'd been then an increase in interest rates, which was significantly higher in the UK than in most other industrialised Western countries.
Yeah.
But that, what you might call excess increase in interest rates in the UK, has all but disappeared now. So by the time we do our autumn statement OBR forecast, really what's happened is that the increase in interest rates in the UK looks pretty much in line with the global increase in interest rates. But it's very big. Just as an illustration of that, if you took 10-year government bond yields that we had back at the time of March, they were about 1.3, 1.4%, and financial markets were expecting that that's where they'd stay pretty much. By the time we came to do the forecast a couple of weeks ago, they were 3.6, so it wasn't far off a tripling in interest rates. And given the stock of debt that households own and that the government owns, that's a very big hit indeed. The energy price increase is also very large. So again, if you go back to the time of March, market expectations for where gas prices were going to be on average in 2023, back in March, were very much lower than they are right now. So right now they're about 80% higher in the global markets. This has affected anybody who imports gas. So I think those are the two big things that have made the UK, coming back to Paul Johnson's statement about the people of the UK just got poorer. I mean, those are the two reasons why it happened. I think the good news is that it's plausible that both of those effects will be somewhat attenuated as you look into the future. I mean, I already mentioned that if you look at the financial market projections as to where energy prices go, actually they fall back quite a lot over the next couple of years. That's very good for households. It's very good for companies in the UK. And even in the short period since we produced the forecast, interest rates have continued to move down a little bit. And the projections for where Bank of England bank rate have always been a little bit lower 2 or 3 years down the road. And our own projections for where mortgage rates go is that it might peak. The average interest rate on the stock of mortgages will go up for a while, but then it will turn the corner and start heading back downwards again based on market forecasts for where interest rates will go. So I think 2023 is going to be a very difficult year, very likely, but the years after it will not be quite as bad.
Thank you. So just going on to public sector net debt, excluding the Bank of England and the underlying measures of debt, it rises to a peak of 97.6% of GDP in 2025 to 26 before falling. Can you talk us through what the triggers would be, which would enable UK public debt to fall as a proportion of GDP?
So there's two reasons why public debt turns around towards the end of the forecast. One is that as energy prices and interest rates fall, although remaining higher than previously assumed, that gives support to the economy. So if you think of energy prices as the price of an essential, it's almost like a tax rise that we're facing at the moment, and it's almost like a tax cut when those energy prices fall back. And so that recovery in GDP growth means that debt over GDP, the GDP is growing more strongly, and that helps. The second reason is the fiscal consolidation measures that were taken in the autumn statement, which are enough to bring borrowing down sufficiently that debt rises more slowly than GDP. So without those measures, debt would have risen forevermore. With them, it stabilises and it falls by a very tiny margin in at the end of the forecast.
Okay, just one more question, which just wanted to see if you concur. Yesterday, the chief economist of Pantheon Economics said that the number of people who are out of work because of being on the NHS waiting list, there are about since 2020 we've seen a rise of roughly 400,000 in the number of people who are of working age but economically inactive. And that's about 1.2% hit on the size of the workforce. When pushed, he thought that it could be a 0.7% hit to the workforce in terms of output. Would you agree with those figures?
So it's certainly the case that one of the, as David was mentioning, one of the reasons why on top of the reasons David gave, another reason why we came out of the pandemic with a lower level of output than and we're going into this next crisis from a lower level of output than other countries, is that we've been a bit unusual in seeing rates of labour market inactivity go up after the pandemic. For a lot of other advanced economies, they actually saw labour participation rise, so inactivity fall in the wake of the pandemic. But nobody really understands entirely why that's happened in those countries and why we've had the opposite effect. The reasons do appear to be complex. There's a mixture of health factors. There seems to be a strong element of early retirement, given the age profile of people who left the labour force during the pandemic and are now not reappearing afterwards. To the extent that a large number of those people are in the older age group, we're fairly pessimistic about their prospects for rejoining the labour market over the course of the forecast that we have here. We have some return, but not very many. So you're still losing hundreds of thousands of people from the labour force from some combination of ill health, early retirement, and other factors that appear to have come to pass during the pandemic. And it is something which holds back output growth and the level of output.
And there are 7 million people on waiting lists, so some of those people do want to return to the labour market, which could. So the question was about this 0.7% hit.
It's something that we want to look into. It would be wrong of us to pretend that we know the dynamics of this. It's something that we definitely want to look into in more detail, because our forecasts heretofore have been based on what had been more optimistic assumptions about returns to the labour market. I think we want to better understand both what the data says about why they're out of the labour market and also what the evidence says about why they're coming back in. We will look at it in more detail, but we didn't get a chance to in this.
Thank you.
Thank you so much, Rishanara. Anthony.
Thank you, Chair. So my questions, at least initially, are about departmental spending. Except for schools and hospitals, the nominal departmental spending was kept the same for the next 2 years as it was under previously under the comprehensive spending review. But inflation is obviously a lot higher than it was when that review came out. How tough is that going to be? How much savings are the departments going to have to make?
So the government has topped up the budgets of health, social care and schools over the years for which spending plans are set in cash terms going out to 2024-25. But for the remaining departments, they are in essence being asked to absorb the hit from higher inflation. We should stress that there is a debate about what's the right inflation index to use to measure the inflationary pressures on departments. It's probably not as high as the double-digit CPI figure, but it's also probably not as low.
Because wages won't be going up as high as that? Or?
Because departments' biggest cost is workforce, and wages are only going up by 5-6%. Government departments don't feed people, so they don't have to worry about the food price, although certainly their employees do, but they don't feel it directly. They feel it through what they have to pay their employees for wages. So in the near term, departments are facing a squeeze from higher inflation, and then beyond, over the current spending review period, from 2025-26, the government has taken some cash out of their spending plans. They took about £18 billion out of resource budgets and about £12 billion out of capital budgets. That means that the growth rate of spending beyond 2024-25 falls from
1%.
Yeah, so it was growing basically in line with the economy, around 2.5%. Now down to 1%. That takes about 30 billion in total out of both current and capital spending combined.
So just in terms of that, so focus on that first bit first. Absorbing the hit from inflation. How difficult or hard is it going to be for departments to do that, apart from health and education?
So it will be difficult, and there is as part of the sort of due diligence of the forecast that we do, we talk to finance directors and departments to ask what kind of choices would you have to make. Their assessment is that it's sort of tough but deliverable, but it means that basically they can't do all the things that they want to do in the near term. And some departments, as I said, are getting additional support for absorbing those costs, whereas others don't.
So beyond that, coming to the 1% increase in spending longer term, which obviously shrinks spending as a share of the economy overall, assuming the economy grows more than 1%. Some people have said that's impossible, just not going to happen. I think you described it as plausible. How difficult is it going to be to meet that spending?
So the reason we describe it as plausible is obviously the government doesn't have detailed spending plans beyond 2024-25, so we don't know what the allocation of spending looks like beyond that. The government does have commitments that it's made on defence and overseas aid to grow those in line with GDP. So those are growing at 2.5 compared to an envelope growing at 1. That squeezes the resources available to the rest. Per pupil, the government's got a commitment on per pupil real growth in per pupil spending in schools, which we assume is also met. And then we make a sort of historical extrapolation of the growth rate in health spending of just over 3% within that, to look at basically what resources are left over for other departments that aren't covered by some kind of pre-existing protection. And what it would mean is that their budgets fall by about 0.7% per year in real terms. And the reason why we say that is plausible is that yes, it's a real cut in those departments, but it's not. It's actually lower than what they've seen in some previous spending rounds. In the spending reviews of 2010 and 2015, that group of departments were facing cuts of 3 to 5% in real terms per year in their budgets. So this is significantly less than that, which is why we think it's plausible. The thing which kind of weighs against it is it's always the same group of departments that seem to be asked to be bearing the brunt of real cuts in their budgets. This would be yet another spending review where they're the kind of Cinderella departments rather than the ones getting real growth in their budgets, and they have to absorb sort of further real reductions in their expenditure. I think the other thing to bear in mind is that while the government has taken £30 billion out of spending in this forecast, chancellors also have a tendency to put around £30 billion back into public spending as the moment of doing a spending review approaches, and they actually have to allocate that envelope out around the cabinet table. So I think in the back of our minds we also recognise that this may well pose quite a plausible risk to the outlook by the time you get to the mid 2020s.
So the various people, not least in the Labour Party, including colleagues on this committee, have declared it's a new age of austerity. But how, in numbers, how does this constraint on public spending compare to what happened in 2010 and 2015?
Public spending is growing by less, but the rate of growth is still higher than you faced in those periods. As Andy was mentioning, during that period you actually had a slight fall in public spending. You had a fall in public spending as a share of GDP. The pressure we measure it as the pressure that it sort of leaves for this unprotected group, and it is on the order of minus 0.7 a year compared to -3, -5 during those periods. But again, there's a sort of, at some point you get to a sort of limit on how much pain you can continue to impose on the same.
So it's that's a fraction of the restrictions, the contraction there was previously then. I mean, it's like a fifth.
It is smaller, yes, but it's still a real cut on a bunch of departments that have previously faced real cuts.
So would you call this an age of austerity?
Those are other people's words. That's not a word.
I knew you could answer.
Those sorts of words are not. They're not economic words, and they're not words that we tend to use in that high document.
But it's not the same as what happened in 2010 or 2015. Obviously you're predicting inflation being very low indeed, negative, a period of deflation towards this. What happens if inflation isn't that low? What's going to happen to the ability to meet those spending targets then?
It makes it more difficult in two ways. One is it increases the financial pressure on the departments themselves, but it will also increase the financial pressure on government. We've talked about how they have inflation-linked debt commitments, they have inflation-linked welfare payments, and if inflation turns out to be higher, there may also be an interest rate reaction, which will put the financial pressure on government. So this whole forecast is premised on getting inflation under control over the forecast period and getting it back into single digits quite quickly, very quickly. If that doesn't happen, then that very much adds to the government's fiscal woes, both in the sort of in microeconomic terms, but also in macroeconomic terms.
Yeah. So coming to pensions and benefits, the pension triple lock, obviously the government has recommitted itself to that. How, and I think that's been welcomed by MPs across the House. How sustainable do you think that is in the long run? Because isn't it inevitable that at some point it'll have to move? It'll just increase the share of the economy that's given over to pensions.
Yes. Excuse me. Our long-term projections for a very long time have shown how the triple lock ratchets up state pension spending as a share of GDP, which is already rising due to the ageing population. It is the 2.5% floor out of the triple lock that is really the element of it that pushes spending up, and it binds in I think it's either 2 or 3 of the years in this forecast, pushing spending up as a share of GDP. The difficult thing about it is that the lower productivity growth is in the economy, the more often 2.5% will be the highest of the three numbers, and the more often spending will rise as a share of GDP. So it is a big pressure on the long-term public finances.
And is it sustainable long-term?
It would be sustainable if something else gives. So the way we do the long-term projections is we lay out the implications of policy and some long-term assumptions about health spending, which show the public finances on a entirely unsustainable path over the long term. That's unlikely to happen, of course, because something will give, but it illustrates the choices that will have to be made. If the triple lock is to be maintained for decades, then it will cause public spending to rise, and then obviously there's choices about, does other public spending fall, do taxes rise, does borrowing rise?
Yeah. So your forecast for welfare spending overall was £19 billion a year more than you previously forecast in March. And that was, I think, mainly inflation. But were there other factors there, and how inevitable or how foreseeable was it?
So around half, little under half of it was inflation, being higher than we expected in March, and also the triple lock binding, so triple lock uprating, pushing up state pension spending. A little of it is the cost of living payments at the start, which we've grouped under that heading. But then there is a big chunk of it that is related to what we were talking about earlier in terms of kind of ill health in the labour market showing up pretty similarly in health-related and disability-related benefits. And that adds up to almost 8 billion-ish by the medium term. Now, was that foreseeable? Well, we didn't foresee it back in March. I think what we've seen over the months in between is there have been very high inflows into the disability benefit system, which were running at about 40,000 a month pre-pandemic and around 70,000 a month this year. We'd always expected there to be some pickup after a health crisis and the difficulty in administering the system through the pandemic, but it's been higher than we thought and seems to be more persistent. There seems to be something similar happening within universal credit in the health-related elements of it. The upward revision is large. We have had some in the past where the systems were changing and we got things wrong about how that would affect spending, but this is it seems to be related, at least in some way, to what's happening in the labour market and possibly to what's happening with the NHS waiting list. So it's really something that's on our kind of priority list for trying to understand a bit better how closely these things are tied and whether the causes are the same or whether it's coincidence that we're seeing it in different places in the forecast.
Finally, last question, because I'm running out of time, if I can quickly. Aren't the main risks to this on the upside, in terms of the welfare budget, because of the increase in economic activity, if inflation doesn't come down as quickly as you expect it to, isn't there quite a big risk that welfare spending will overshoot?
I mean, I think the risks are in both directions. If inflation comes down faster, the opposite would be true. In terms of this, what we've done to the health and disability benefits, we now assume that these caseloads rise as a share of the population throughout the medium term. So you could think, hopefully that might be pessimistic, but that seems to be what the data are showing us at the moment.
Okay, that's all the questions I have.
Thank you so much, Anthony. And Emma.
Yeah. Thank you, Chair, and good afternoon. I'm not sure how closely you've been following Northern Powerhouse Rail, but you will have seen perhaps that it was in the Conservative Manifesto in 2019 taken out by Boris Johnson, put back in by Prime Minister Liz Truss and taken out again at the most recent budget. And this was all part of the Chancellor's decision to keep the capital spending flat beyond 24-25. And so I just wondered if you're able to tell us now or in writing what the impact of keeping that capital spend flat from 24-25 would have on nominal or real GDP, interest rates and tax revenues. But if you're happy for you to put that in writing, if you're not able to.
Happy to put it in writing. I guess just in outline terms, what it means is that the full increase in public investment that was planned back in March of 2020, which saw about a 0.7% of GDP increase in public investment, which sounds like a little bit, but it started below 2. So, as a share of total investment, that was a very big increase in the volume of public investment compared to what we're used to do in the UK. That would have, in the long run, increased the public sector capital stock by about a quarter. And it would have increased the long-run growth rate of the UK in the long run. Now, I mean, long run is well beyond the 5-year period in this forecast by 0.1%. Given that some of that has now been pared back, and when we come time to do our long-term forecast again, we will need to reassess how much of that capital stock we now expect to be there and how much growth will that be supporting. But it's almost certainly the case that the direction will be negative for growth and for productivity in future, because you will have less capital supporting less economic activity in the long run.
Okay, are you able to say anything right now on the impacts it would have on interest rates or tax revenues, or do you want to put that in?
Let us do a sort of a proper answer to that rather than me guess off the top of my head. But the effect on interest rates is probably a minor, if not zero. In terms of tax revenues, a smaller economy generates less in terms of tax revenue, so you would likely lose out from that.
Thank you very much. In the statement, the Chancellor claimed that our actions today help inflation fall sharply from the middle of next year. But I was just reading earlier, so excuse me for reading it off my phone, that the OECD have actually said, have actually laid some of the blame for the UK's poor performance on the energy price guarantee, and that they think, the OECD warns that it will add to overall demand in the economy, increasing inflationary pressures in the medium term. So the OECD saying that the energy price guarantee is going to increase inflation, and the Chancellor saying in his statement that his actions today are helping to decrease inflation. So who's right?
David?
Well, it decreases inflation pretty much in a guaranteed way that one can quantify quite well, I think, which is, how much higher would energy bills be to households, and that would feed through to consumer price inflation, and that would be something like 2.5% higher in the relatively near term. So instead of inflation being around about 11% now and into the early part of next year, that would have been 13.5%, maybe even 14%. So I think that bit is pretty easy to quantify. I'm not quite convinced by the OECD argument that it also causes inflation, that there's an offset to that because inflation's higher. I mean, it's true that the support measures to households, to companies as well, is expensive fiscally. It adds up to something like £100 billion over the next 18 months or so. That's extra spending power in the hands of households and companies. actually, the way I would describe that is it makes the recession shallower than it otherwise would have been. That might have some marginal impact because unemployment would have been higher without that. Maybe wage settlements would have been a little bit higher. But, I mean, to my mind anyway, those are all kind of second-order things, whereas the first-order thing is you could pretty much guarantee inflation would have been 13.5%, 14% in the near term without the support package.
Okay, I'm just going to quote what the OECD have said and then just ask for your comments on it. They've said, better targeting of measures to cushion the impact of high energy prices would lower the budgetary cost, better preserve incentives to save energy and reduce the pressure on demand at a time of high inflation. Are they right?
Well, I think it's a slightly strange way to put it. The final point they make about pressure on demand. We're going to have a recession almost certainly next year. We're probably at the optimistic end of the spectrum and thinking it's going to be relatively shallow, but it still opens up a degree of what you might call slack, spare capacity, insufficient demand, frankly, in the economy. And the support measures make that less bad than it otherwise would have been. So I find the OECD description a little bit strange, to be honest.
It's interesting. So looking beyond the energy price guarantees, putting that to one side, does the fiscal consolidation in general in the budget, in the statement, help to bring down inflation throughout the forecast?
Well, I think the sort of strategy is to give an enormous amount of support to households and companies in the near term over the next 12, 18 months or so, which has a logic to it in a sense, because that's when the hit to people's budgets is greatest, when the reduction in demand otherwise would have been even bigger, when real disposable incomes, which already we think fall something like 7% over the next couple of years, would have been even bigger, would have been more like a 10% fall. And you kind of claw the money back toward the back end of the forecast further down the road. So again, I mean, it's true that if you didn't have that strategy and you didn't provide that much support in the short run, inflation might be a bit lower because unemployment will be that much higher and the recession will be that much deeper. Whether or not one thinks that's a good trade-off to make, I'm not sure. I'm not convinced myself. But
yeah, okay, that's really interesting. Thank you. So you've got inflation falling into negative territory from 2024, which is way below the bank's 2% target. Does this suggest that the market forecasts for interest rates on which you base your own forecast are too high, as the Monetary Policy Committee themselves suggested at their November meeting?
Yes, I mean, Ben Broadbent, one of the deputy governors of the bank, before the November monetary policy decision, made a speech in which he made it very clear that at that time he felt, with some justification I think, that the market expectations of where bank rate were going to go were too high. And they subsequently dropped back a bit, and we captured a significant part of that in our own projections. We just used what the market expectations were for bank rate by early November or late October. As you rightly say, plugging those into our models, we get inflation dropping down to zero and becoming very mildly negative for most of 2025. And you might look at that and say, well, that just says the Bank of England is not going to leave interest rates at the level that the market implies if you get down to those low levels of inflation. I'm not so sure about that, because the Bank of England, I mean, quite rightly, has a tendency to look through temporary big overshoots and undershoots of inflation. So they're doing it right now. I mean, inflation is 11%. The Bank of England is not setting an interest rate to bring inflation down to 2% by Christmas, because if they did, they'd need interest rates at 10%. And they know that that would be dreadful for the economy. And the chances are, I mean, on the bank's own forecast, inflation does come back down. In fact, the bank's forecast is inflation drops down to pretty much close to zero for a short while, a little bit further down the road. So I think what the Monetary Policy Committee strategy is makes a lot of sense, which is if you think that inflation has moved away from the target for a few quarters, maybe even 4 or 5 quarters, but it's going to come back, don't add to everybody's woes by moving interest rates dramatically to try and bring it back really quickly. And that's what they're doing right now pretty clearly. And I suppose our forecast implies that they do something similar on the other side of it if inflation temporarily drops down to zero or maybe even goes negative a little bit. When if you look further down the road, at least in our forecast, by the time you get through 2026 and go into 2027, inflation is coming back to the target. So would the Bank of England take interest rates to zero or even set them at negative levels simply because the inflation rate in the middle of 2025 is zero or mildly negative? If they look through all that and say, well, it's going to come back to 2%, let's not overstimulate the economy right now, then I think one can make a bit more sense of the market expectations for bank rate and our own forecast for inflation.
Thank you very much.
Yeah.
I've run out of time.
Thank you very much. And we've got the OECD and the IMF. We've invited them both, and hopefully we can get them timetabled so that we can ask them their side of the story. Yeah. Thank you. Great questions. John.
Thanks, Sarah. Can I stay with inflation but bring it to bear the subject on our debt interest payments and spending, if you like? We know that overall debt interest spending is going to double this year compared to last. But we also know that index-linked debt, if you like, has quadrupled in the last certainly 20 years as a percentage of GDP, rising from something like 6% to 22% of GDP. So inflation is much more relevant to how much we obviously spend on our debt interest payments. Now, you'll have to excuse I'm going to be slightly provocative here, but some of us are sceptical of forecasts when it comes to inflation. For long periods when it was clear that courtesy of quantitative easing, artificially low interest rates, that inflation was in pockets of the economy, that we had high monetary growth, and yet still the policymakers, not just here but globally, were saying inflation is not a problem. Then when it was evident it was going to be a problem, it was going to be transitory. When it was evident it wasn't going to be transitory, it was going to fall away this year. I mean, there's a pattern developing here which doesn't inspire confidence. I mean, you have inflation falling into negative territory from 2024. I mean, I put it to you that, that's for the birds, isn't it?
Well, we'll see. I have to say, I hope we're right, because actually it would, if it turned out to be right, it would be very helpful to households, because the reason it might turn out to be right is that the market expectations of oil and gas prices itself turns out to be a reasonable guide. Now, that may be wrong. We use it as a central forecast, but the uncertainty around that is obviously enormous. If one went back to the middle of 2021 and asked what was the market forecast for where gas prices would be today, I can't remember exactly, but it would probably be about 60 pence a therm, and they're £3, whatever they are. So there's 6 times higher than
yes, but if I come in there, I mean, inflation was rising before the Russian invasion of Ukraine.
That is true. No, absolutely.
And monetary growth was going through the roof, and still policymakers, not just in this country, it has to be said, were suggesting that inflation is not going to be a problem. Now, we'll see what happens when the energy prices fall out, but it's a much bigger problem that policymakers originally forecast, and they have now playing catch-up, having been behind the curve.
I have good sympathy with what you say, because I think there was a tendency during the course of 2021 to stimulate demand through monetary policy, perhaps paying less attention than in retrospect should have been paid to the diminished supply potential of the economies and bottlenecks, and here in the UK a labour force that was actually smaller than we thought. So you ran up against, if you like, demand pushing up against the supply capacity of the economy, and that has nothing to do with Ukraine. And
no, it doesn't.
I agree with that. But I think the reason why we have had such a spike in inflation which otherwise may well have gone above the target levels of central banks.
Which it has been above for quite a while.
Which absolutely, which it was before the energy price thing. But I think what was added to that was something which was much more powerful, which was just this enormous increase, which then took inflation into double-digit figures.
Can I, because I'm conscious that we've still got a little way to go, etc., with other members wishing to speak, but can I just press you a little bit on this forecast that inflation is going to fall into negative territory from 2024? To what extent do you step back from the minutiae detail and look at medium-term drivers of inflation? I put to you that, business supply chains are being shortened as we speak, partly because of geopolitical tensions are hardening, but also because of the pandemic. That is going to be inflationary. We've got climate change increasingly disrupting weather and causing food shortages and other things. We've got ageing demographics, which means it's going to be compound the labour shortages. We've got the existence of zombie companies, courtesy of these extremely low interest rate policy that all governments, or most governments, have employed, which has represented or resulted in a misallocation of capital. There's no more creative or very reduced creative destruction to make sure that the capital is allocated to more productive means. And when inflation gets embedded, it stays there. It's very difficult to shift. It enters the human psyche. Now, those medium-term drivers, which I accept are difficult to forecast and put on a data set or a computer, because how do you forecast human behaviour, suggests that inflation is going to remain elevated and volatile for some time to come, doesn't it?
I mean, I think you're right, in the sense that if expectations of inflation really get baked into people's psyche, and people, if they can, push for 7, 8, 9% wage settlements as far ahead as one could look, it is very, very unlikely that inflation will drop into negative territory.
But what about those other medium-term drivers, if you don't mind me asking?
Well, I think those medium-term drivers to do with demographics and supply chains absolutely affect the supply potential of the UK economy. And our forecast reflects some of that, because we think the supply potential of the UK economy, by the time you get to 2027, is 3.5% less than we thought in March. So we have embedded in our forecast a big hit to the supply potential of the UK economy. But what we also get in the short run are two things. One, a really sharp slowdown in the near term, which creates quite a lot of slack in the economy. Unemployment goes up. Demand falls short of even a diminished supply capacity of the UK.
Can I just, very finally, ask then, why do you think policymakers, not just here, as I say, this is a global fund, have got it so wrong about inflation in the past?
I think, excuse me for slightly repeating myself, but I think it looks such a catastrophic error. It looks that way, as opposed to a smaller error that was nonetheless significant. It looks sort of catastrophic when you have a central bank with a target of 2% inflation, the inflation rate is 11, and would have been potentially 13.5% were it not for government support in the form of the energy price guarantee. That looks catastrophic. I think a significant part of the catastrophe there really is global things that no one could easily have predicted, and they're coming from the Russian invasion of the Ukraine and what's happened to gas and energy prices. So I think one has to strip that bit out, because in a sense it's a forgivable error.
Even though they were ignoring monetary growth figures, evidence of
I agree.
Inflation in widespread parts of the economy.
That aspect of not having tightened policy or in fact loosened policy on such a scale during 2021, I think could legitimately be described as a policy error. It's perhaps easier, I describe it that way, it's easy for me to say that in retrospect. I think you perhaps saw it ahead of many people listening to what you're saying. And that's a policy mistake. But I think it exaggerates it a bit when one looks at just the headline numbers for inflation now and into the next 12 months. because on top of that was the thing that you could be, I think, forgiven for not forecasting.
Thanks,
Okay,
John.
thanks.
And before I bring Siobhan in, just on this number that you've put in of 120.4 billion for interest this year, so nearly 5% of GDP. A lot of that's to do with the index-linked structure. How much is a cash accrual and how much is an actual rolling up in terms of the index-linked principle?
So, and if I don't precise answer this, but it's certainly the case that the spike you see in interest costs this year is partly cash interest going up on nominal yields, but another large effect of that is the fact that all of the impact of the accrued stock of indexing debt gets scored in 1 year as a time.
Indeed, and do we know how much that is? What's the breakdown?
Well, so the total spending on indexing gilts is 72 billion, and almost all of that will be the accrual reflecting the fact that the value of the debt has gone up. And
So
a very
that
tiny amount
it
will
won't
be
be in the
cash.
financing requirement of the Debt Management Office. Okay, thanks very much. Siobhan.
Thank you. I just want to look at issues about personal income tax. Your economic forecast states that by 2024-25 the tax burden will be its highest level since the Second World War. What impact will such a high tax burden have on economic growth?
So I think the economic evidence across countries and historically at the kind of tax burden we're talking about in the UK in this forecast is that there's not a tight link between how economies grow and how high the tax burden is, essentially because these are relatively moderate tax burdens. So and the tax rates that are charged are relatively moderate. There are no 80% tax rates left. So if you look across, say, Europe, you can find countries with higher tax burdens than the UK that grow faster, and you can find ones with lower tax burdens that grow faster. So we don't look at the tax burden as a way to forecast growth. We look at individual tax measures. So in this forecast, we've got several measures that raise personal income taxes, and within the forecast there are things that were announced previously, in particular the threshold freezes throughout personal taxation, which are I'm careful not to say they're raising a lot of revenue, because essentially we have negative real income growth at the moment. So what those threshold freezes do is reduce the extent to which revenue is lost through real incomes falling. But relative to where the threshold would have been if raised with inflation, they raise 25 to 30 billion, depending on which measures you include, by the end of the forecast. I'll probably ask David to go through the detail, but we assume that has a moderate negative impact on labour supply.
You're anticipating my next question.
Well,
no, go ahead, Jim.
Well, I'll probably stop there and let David take over on how we think about what that does to the choices that people make in the labour market.
The tax measures, I think, in the budget do a bunch of different things. Some of them, obviously, because the value of allowances will be eroded, there are more people who face higher tax rates, and their marginal tax rates are higher. And our assessment is that, on balance, that's a disincentive to work. It's a disincentive because we think that there are two offsetting effects, one of which is slightly more powerful. So, you get less pay to keep as a result of working the extra hour or the extra day in the week. That's a disincentive.
Sorry to interrupt,
on the other hand,
David, but also incentives for promotion. I'm just thinking about, in the public sector in particular, becoming a police sergeant or becoming a deputy head or a head of year. Yeah. No, you're right. The disincentive effect is clear enough from higher taxes. There's an offsetting effect which goes slightly in the other direction, which is that higher average rates of tax, and for many people the average rate of tax they'll pay on their income is going to be that much higher. To the extent that it reduces their disposable income, if they try and compensate for that, they might well work a little bit more. So you've got
in economics jargon, you've got a substitution effect, which is a disincentive to work, and you've got an income effect, which is because your after-tax income is lower, you might actually work a bit harder. Our judgment is that the distortionary negative effect of higher taxes is stronger of those two. So you do get a negative effect on the supply potential of the economy from labour supply being lower than it otherwise would. And things like freezing the tax allowances over time will do that. So that's a negative. Of course, we've also had the decision not to implement their health and social care levy, so that's a reduction in tax. That is an offset to that. The net effect of all this, we think, is a small but nonetheless non-trivial slight reduction in the labour supply in the UK. I agree very much with what Andy was saying, which is that within limits, the tax takeout to GDP can go up or down a few percentage points, and it probably doesn't have an enormous negative or positive effect on the supply potential of the economy. But one can't push that argument too far, because there does come a point, and it may be that we're not so close to that point yet in the UK, and it does come a point where the distortionary effects just get greater and greater, and they're likely to be what you might call non-linear. So whilst I agree that the distortionary effects of the kind of higher overall tax takeout of GDP that you might see in the UK might not do what you might call material damage to the supply potential of the economy, the idea that you can just keep doing things like that without doing damage to the supply potential of the economy is clearly not true.
And not everybody gets treated the same, do they? It was notable that I thought the autumn statement was notable for its absence of the words non-dom. Research from the LSE indicates that clamping down on non-doms would raise around £3.2 billion. Is this a figure that you recognise?
We don't work on or comment on policies that the government has not asked us to work on, so I'm afraid that's a question for somebody else.
Okay.
We have obviously scored the measures the government took quite some time ago to tax non-doms as the amounts they do now. We haven't explored alternatives.
Okay, and probably you're not going to want to answer my next question either. The government's stubbornness is resulting in tax-free incomes for the millionaires, while millions face frozen tax allowances and council tax hikes. Some say 3.2 billion is a drop in the ocean. Do you agree with me that when it comes to public finances, that's rather a large drop?
That doesn't sound like the kind of statement I could comment on.
Okay, those are my questions, Chair.
Thanks so much. Right, I'm really Chair. Taxation is clearly a very important part, and how you adjust it to the overall economic growth. Yesterday we had a group of economists in, and their overall comment was that while a lot had been done to address the tax and spend issues, that in terms of meat about growth, it was a bit thin, as in levers to actually deliver that growth. Therefore, it becomes increasingly important to make sure that the tax measures are right, proportionate, and will deliver what's expected so that they don't dampen growth. When you look at the increase in the personal taxes and the business taxes, which do you think has the biggest impact on growth, and therefore we should be most concerned about on the growth agenda?
So I guess I echo a point that David made, which is that you did see some significant changes to tax policy in this autumn statement, and in the run-up to it considered even bigger ones. In the end, they've had sort of broadly offsetting effects, because you've had a big reduction in personal taxation. You haven't gone ahead with the health and social care levy, but then you've frozen the thresholds. We think that the sort of net effect of that is smaller than the effect that any one of those measures would have had, but mildly negative for labour supply. You've gone ahead with the corporation tax rise, which has an effect on post-tax incentives to invest. But overall, if you look at how we've written up the policy measures in the book and the way we've analysed them in the forecast, there's really been not very much long-term growth effect from any of from the net effect of all the policy measures taken in this autumn statement. There are other factors which have led us to slightly change our view of long-run potential output in the UK, but none of it really derives from the policy measures taken in this budget. There are some actions like the ones we had on the public investment side, which in the longer term could have an impact on supply potential. But I think, to be frank, what's notable about this forecast in policy terms is that very few of them fed through into our assessment of long term.
And that will be true, provided that the estimates, particularly for something like corporation tax, because that's a big earner, are right. So I was a bit surprised, perhaps now I understand given what you said, that you think it will lower output by only 0.2%. And when I look at the figures, the billion expected tax receipts over the years, in 23-24 we're looking at 88.8 billion, in 27-28 we're going to 105.4 billion. Those are big numbers which seem to me to raise a question mark. How certain are you? What's your level of certainty? And perhaps before you answer that, let me just refer back to something which Professor Miles said earlier, and that was his assumption that the energy prices would come down, and therefore that was the justification. And I think my concern about that comment is that while wholesale prices have absolutely come down, they're now lower than they were pre-pandemic, the challenge we have is that the output, the spend by the businesses and the individuals is the retail price, not the wholesale price. And a number of individuals, partly through fear factor, partly because they were incentivised to do so because that meant that they could then benefit from the government schemes, entered into sometimes quite long fixed-term contracts at the highest rate, sometimes for periods as long as 5 years. Does that not give you pause for thought that your assumption and then feed in that energy prices coming down is going to make this all right on the night is perhaps a little optimistic?
So, on your first question, and David will want to comment on the overall, the sort of underlying optimism of the forecast as a whole, but on your first point about how uncertain are we about the corporation tax forecast, I think the answer is it's among one of the most uncertain aspects of our forecast always, and in particular this time, in that corporation tax is levied on profits, it depends on the profitability of businesses, it's by its very nature, and there are lots of allowances in the system, so it is by its very nature much more volatile than income tax, which so long as people have a job and they're getting paid, they pay. This time around there are some big tax changes, some big changes in rates, which could have larger behavioural effects than you might expect from smaller changes, as well as some quite novel things going on, the sort of Pillar 2 reforms, which levy a sort of minimum level of, sort of try to collect a minimum amount of corporation tax from companies resident and operating in particular jurisdictions, raise huge uncertainty about are these things going to be able to be implemented, and then once they are implemented, how successful are they in a given period. So in that sense, our corporation tax forecast is always very uncertain, and there are sort of additional reasons to be uncertain this time around. On the sort of wider question of the uncertainty underlying our sort of whole economic forecast and the business investment part of it, I don't know whether David wants to add more to that.
I think that there are lots of sources of uncertainty in the forecast. And you've highlighted one, which I think is one of the big ones, which is what happens to wholesale energy prices, and does it get passed through to households and companies? Our central assumption is that the market forward curves for the energy prices tell you something about the most likely path. But the price could be dramatically different from what the markets are expecting right now, and if they are, it will make a very big difference to the forecast. And it could be the difference between inflation, 0 or slightly negative in 2025, and inflation being, 4, 5, 6%. So, which will have a huge impact on households and disposable income and all that. On the issue of some people have hedged and used futures contracts and they fix prices, that's absolutely right. Our assumption is that as you go further into the future, those kind of hedges roll off, and ultimately the underlying wholesale price is what drives the cost to people. But you're right, it affects the dynamics of when they start paying for things, that's true.
Okay, because my concern is you were talking about this falling in 24-25. If you're on a 5-year fixed term contract...
Yes, no, then it won't make any difference. You're absolutely right. By the point at which our forecast actually gets inflation down to slightly negative territory, it's a little ways down the road. It's sort of toward the middle and back end of 25 going into 2026.
Can I then ask you, tariffs on 100 goods are to be removed. So do you think that will shift your growth expectations? How much difference will it make, and what goods do you anticipate are going to be impacted by this?
That's probably one for me.
Yeah.
This has not affected our growth forecast, basically because the measures themselves, they cost around £150 million, so that's very small relative to the economy. I'm afraid I'm not sure if all the goods are in the public domain, but these are goods that businesses have requested to be zero tariff, and the cost reflects how much of them is imported. So it's very important for those involved, but macroeconomically quite small.
All right, I accept that, and I can only assume, therefore, it's more to do with, if you like, emotional, cultural, feel-good factor rather than necessarily purely financial, which might change behaviour. Otherwise, you're right, it is very much small beer. R&D, very important, and indeed the Chancellor said it was very important and said that was something that he wanted to ensure we retained. And yet, the Chancellor cut R&D tax credits for small businesses. What's the impact of that going to be? Because the FSB, as you know, are absolutely aghast and in full flood outcry about it.
So again, in the forecast, we've assumed that in terms of what it means for the volume of R&D spending, that the gains from making the large company scheme more generous offset what you lose from making the small company scheme less generous. And so we've left our business investment forecast unchanged because the composition changes, but the total doesn't. Now, the R&D tax credits, it's one area of tax policy where the evidence on its growth impact is quite strong. But the other thing that has become increasingly apparent in recent years is that the small company scheme was being abused as well as being used properly. And so we do assume that some of what happens as a result of making the small company scheme less generous is just that there's less fraud in the system, so less money is lost that way. So that's why the combination of the two measures raises money, but in what we kind of think of as the appropriate use of the two schemes, the rebalancing really is a balanced rebalancing.
Okay. I'll move on to investment zones, but it seems to me from what you're saying is proportionally the smaller businesses are being penalised to deal with a fraud problem, whereas in fact perhaps isn't the right way. I appreciate you're not going to comment on policy, but that was a very interesting comment, thank you. So the investment zones have been moved, so effectively instead of being part of levelling up, they're now part of potential high clusters. That will achieve a very different objective to the objective that was initially set. Clearly it's a policy issue, not for you, but in terms of, if you like, the impact on economic growth, will that achieve it, and what do you see as the targets? High potential cluster, are we talking university, are we talking high-tech areas?
I think it's too soon to say. I mean, my reading of what's in the autumn statement document is that the government's in a kind of talking to stakeholders, figuring out what the best approach is phase. There have been similar policies over the past decade that we have looked at. So the enterprise zones that came with business rates relief and those kind of things, and the free ports that are getting underway. Neither of those have we moved our growth forecast for them. The thing we tend to worry about when we look at them from a growth perspective is essentially whether they're regional policy that moves activity around the country, or whether they are growth policy that increases the size of the pie. And I think with the enterprise zones, the evidence was, very largely that they moved activity around. Yeah. With the free ports policy, I think the Treasury was quite careful in how it put together the prospectus approach there to try to avoid that. Now, we've basically taken a kind of wait and see approach on that. If they are successful, then it will show up in growth, but we haven't anticipated that. So this will be, I think, in the same camp when the details come forward.
Thank you, Chair.
Thank you very much indeed. Alison.
Thank you very much, Chair. I've got some further questions around energy support packages, and I just wanted to ask first of all how the total cost of the new energy support package compares with the one initially announced in September.
So as announced in September, it would have been, so just looking at the energy price guarantee for simplicity, so it would have cost 25 billion this year, which is the cost of the scheme as it's going ahead. About 27 billion yet next year, whereas by raising the cap to £3,000, the cost is more like 13 billion. And then by stopping it after next winter, rather than extending it through the following summer, that saves another about 4 billion.
Okay, so quite a significant difference between the two there. And in your section on the various economic and fiscal risks within the EFO, you note the various cliff edges regarding energy-related support. Can you tell me a wee bit more about the kind of risks of those cliff edges and what that will mean for people in the real economy?
So, when we're talking about cliff edges, we're just talking about the schemes ending or changing at different points. We're making, I think, a relatively simple point that, what you saw through the pandemic with the furlough scheme was that there were several end dates, and the Chancellor looked at them each time relative to what was happening in the pandemic and decided to extend it a number of times. So the rise to £3,000 in April is, during the recession in our forecast, and obviously the ending after the following winter will be, depending on what energy prices are, could have very little effect. I think the wholesale energy prices at the moment, if they are proved right, which obviously we've discussed is very uncertain, then when the off-gem price cap comes back into play, energy prices will basically smoothly move. But if energy prices were much higher, then there's a potential for another step up there.
Yeah, so there's a huge gap really between what could happen in various different scenarios, and that will have a significant impact on what the figures the Chancellor has to play with then.
Yes, and obviously they'd have big impacts on everything else. If energy prices were higher for longer, you would expect the economy to be weaker, tax revenue to be weaker. So this is a very direct and kind of visible impact, but it would affect everything.
Yeah, but quite significant uncertainty within these forecasts.
Absolutely, as you'd expect in a big energy shock.
Okay. How much would reduce the government's bill if it passed on some of those additional costs and the uncertainty to households by raising the energy price guarantee again?
Beyond its current end date? Well, as I say, if wholesale gas price, if the futures market is a good guide to the future, then wholesale prices suggest that the off-gem price cap will be around about £3,000 in early 2024 and declining quite steadily. So in our central forecast, there's nothing more to change. If you extended the cap at a higher rate, it wouldn't bind. But obviously there's huge uncertainty around that.
Yeah. No, that's fair. Have you done any modelling on the effect that government support schemes will have on energy consumption within, how people respond to these types of schemes and what they will do?
Yeah, the forecasts embody some work that I think it was that the government did a few years ago that suggests it puts an elasticity, so the response of energy consumption to higher prices. I think the number is 0.1. So 0.1 is for every 10% the price rises, consumption falls 1%. That's a small response because energy is obviously an essential. In other markets, it would be much higher. So the forecasts embody that. I mean, I think what we've seen in some of the, there isn't kind of hard data on this yet, but some of the people monitoring what they can about energy usage in October, the first month of the EPG, was down a lot. Of course, it was an unseasonably warm month, so I'm not sure what we can draw from that.
Okay. And there's been quite a significant bit of chat about the impact of increasing the home insulation money, and the government has proposed. A lot of that won't kick in for a while, so it's maybe outside your kind of forecast area. But would you have any kind of impact of how much insulation would have to be put in to see a significant impact in energy usage?
I'm afraid I don't have an idea of that.
Okay, that's fair enough. To sort of go further on Anne-Marie's point around the impact on business, the businesses in my constituency have shown me some of the eye-watering bills that they're being asked to sign up right now. I mean, it's really quite unaffordable, but there is no other contract on offer. And for them, for some of those businesses, they're looking at that in terms of, well, the only way I can save any money is cutting production. I can't save it on staffing, I can't save it on the cost of the building, I can't, there's no possibility of saving anything on these bills because that's the cheapest I can afford. What impact does that have more widely in the economy if there isn't support for some of these businesses come the spring?
So within our forecast, the support for businesses is assumed to end in the spring. I know the government are reviewing it for what will be put in place afterwards. That's one of the factors in it pushes up inflation for those businesses that can pass it on, and it affects economic activity. It's one of the reasons why there is a recession. I don't know if David has more to say on that.
Well, and not just the recession. I mean, even though we think the best guess, and it's not much more than a guess, is that energy prices drop back, they still drop back to levels that are way higher than they were just a couple of years ago. And because of that, we think that there's a hit to a permanent hit, as long as energy prices stay at that level, to the productive capacity of the economy. So I said a while back that by the end of the forecast, we think the productive potential of the UK economy is 3.5% lower than it otherwise would be. And a big chunk of that is to do with energy prices just being permanently higher than we used to think was normal. So it's a long-run effect, not just a sort of short-run effect.
And is there any particular impact? So thinking of some of the businesses that I've been speaking to, and a whole range of different large and small, some charities as well, they've got these baked in additional costs. Is there a kind of point at which you reckon companies can't afford that anymore, and you see a wave? There's already, I think, an increasing rate of insolvencies. Some companies have built up a lot of COVID debt, they really don't have anywhere else to go with this additional cost. And is there a point at which there becomes a tipping point for the economy there as well, where you're seeing prices that businesses can't afford, and then a subsequent round of further unemployment? Because I think you've talked about unemployment going up at some stage as well.
Well, I mean, I think that's right, but it's tipping points for individual businesses, and then as that accrues, that it looks smooth in our forecast for GDP, but that's because that's the total. Yeah. For the total is is a combination of those for whom it's the end of that business, and those who can pass the cost on, and those who can find another way. So I don't think there's like a tipping point where the economy goes into free fall. It's just if prices remain higher and higher, then more and more activity is unprofitable, and then that's the effect that David was talking about, like the long-term damage that's done to the productive potential, because a key input to production is more expensive.
And it's a particular challenge for manufacturing because they just tend to be much more energy intensive than service industries, although some service industries have big premises which you have to heat and light, and so they have energy bills which are a big share of their cost. But it is one of the reasons why you referred to the OECD report earlier. They have a fairly sort of idiosyncratic set of countries in terms of their growth outlook in the coming years. In that another country which is also suffering particularly over the next year is Germany, and that is for a slightly different reason than the UK. Germany has a very big manufacturing sector. They're paying much higher production costs. In the UK, we rely a lot on gas for household heating and household electricity, and businesses do it to some extent if they're in manufacturing. But for the UK, it's high gas prices put pressure on households, on consumption, and on inflation that way. For countries like Germany with large manufacturing sectors, it puts pressure on production because it's a big input into production. But there are parts of the UK where we have big manufacturing sectors, and they're an important employer and they're an important part of the local economy, and that can have knock-on effects on the rest of the economy.
Okay. Have you done any modelling or forecasting about the cost of extending the current energy support for businesses and what that could look like?
Again, because we're required to forecast on the basis of current policy now.
Okay. I'm just curious because it sounded from the Chancellor as if there would be some announcement between now and next April, and I just wondered where that's going to fall outside your forecasting here, but before you come back to us with another forecast. So I was just wondering if there's any opportunity to take that into account in a separate report, perhaps.
That would have to depend on
what the Chancellor
when the Treasury is reviewing it, I think is what the announcement was.
Okay, because I'm a bit concerned that that's falling out with this and your next one.
Yeah, I mean,
in terms of that
you would
forecast.
expect it to be captured in the budget.
Yeah. And finally, I just wanted to ask very quickly about your assumptions around immigration within the report, and if there's anything more you could tell me about the basis on which you're making those assumptions.
Sure. For a long time, well, since the referendum, we've assumed we revised down our assumption about the long-run steady-state level of migration in the UK at the time, around the time of the referendum, in anticipation of the fact that our decision to leave the EU and also our ability to set our own migration regime would, in the long run, have an effect on net migration into the UK. It had been running at sort of over 200,000 for the years running up to the referendum. We assumed that the government's post-Brexit migration regime, which was announced and implemented in 2020, would reduce sort of average levels of migration down to something closer to 100, just over 100,000, 129,000. As it's turned out, and as we've observed the new system in operation when it came in early 2000, net migration levels have stayed in above 200,000. The last number we had to the year to June of this year was 239,000. And so in light of that, it looks as though the government's new migration regime is basically just allowing in more people than we had anticipated. And so on that basis, we've revised up our assumption for the long-run steady-state level of migration from 129,000 to 205,000. And at the moment, it's a bit above that, at around 239. So it's sort of it falls slightly down to that higher figure than we had as the basis for net migration in our previous forecasts.
Okay, that's interesting. You probably won't want to comment on this, but there was some rumour that the Home Secretary had resigned in part about the forecasts around immigration within the sort of economic assumptions.
It's not something I have any knowledge of.
Okay.
Thanks, Alison. And Danny, I think you had one quick question on this topic, didn't you?
If that's,
and then I'll bring in Andrea. Yeah.
Okay, thanks, Chair. I just want to push you a bit harder, if you don't mind, on this question of energy costs falling, because I think it feels like we're sort of betting the farm on this assumption. I mean, the whole basis of the forecast that you made, which is, in a sense, propping up the government's autumn statement, is on the assumption of very radical falls in energy costs over the next year. And when we were asking you why you assume that's to happen, you say, well, that's what the market is predicting. I mean, that's what markets do. They make predictions, they make bets. I mean, is that really it? Or can you give us your own assessment of why you think energy prices are going to fall? Actually, there'll be negative inflation in energy next year. What is the reason for that? Are you assuming the war's going to end? Is that it? Or is there some massive increase in supply? What is it?
So we do rely on the futures curves as the guide for what energy price to use in our forecast. And I should say it's it's a convention used by most other macroeconomic forecasters. The Bank of England do the same. We are at pains to do sensitivity analysis and risk analysis around those numbers to explore the implications of different scenarios. And actually, back in July, we produced a whole chapter of our fiscal risks report looking at the risks around the outlook for energy prices, including scenarios where the prices came back more quickly and stayed low, as well as scenarios where prices stayed high. Without getting inside the mind of people in the markets, you don't quite know what they're thinking about where energy prices are going to go. But you're right; it does assume that at some point in the coming 2 to 3 years, supply pressures on Europe ease through a combination of finding alternative sources of gas, LNG in particular, which has been rising, potentially an end to the war in Ukraine, but that is anyone's guess, not something that we have any expertise in forecasting, and for that reason don't even try. And then also there's an element of demand destruction, which is that people shift away from lower the energy intensity in general of either their household or their business, or they find alternative sources of energy from gas as a way of bringing down the overall cost of energy to the country as a whole. And we assume that some combination of those things does bring down gas prices, and that appears to be what also markets are using. But you're absolutely right. A huge amount depends on that, that coming to pass. We do explore scenarios where gas prices are higher, and we are at pains to try and emphasise where we make these kind of judgments and our forecasts are conditioned on them, what the risks around those are.
Well, another £70 billion on the energy price guarantee is if the energy prices stay as they are.
And also a lower potential output for the UK as a country very dependent on gas for its electricity as well as heat.
There is another way of looking at this, which is that the wholesale prices stabilise at a level that is 3 or 4 times what was normal before the war, before the pandemic. The world does not have less gas. It's that it's being disrupted by geopolitics. So one could look at this and say, why doesn't it fall all the way back to where it was? And maybe that is because the market doesn't think the war is going to end, or something else. When we were looking at energy prices in the summer, like some of the pushback we had from the experts we were talking to is that assuming fossil fuel prices remain high forever is just inconsistent with if you believe the world is going to be able to wean itself off fossil fuels and move to renewables, because the demand for them will fall.
Thanks.
So uncertainty is huge, but I think it does go in both directions.
Thanks very much, Danny. I'm going to bring in Andrea.
Thanks. Thank you. Pleasure to see you, and my sincere apologies for leaving for a chunk. It was a pre-existing commitment to a school, so I couldn't just let them down. So do say if someone's already asked you that question, and I'll try to avoid asking something that strays. But I did want to just start off by, I think Danny's made the point very well, the inherent difficulty with forecasting. And inevitably, the one thing you can be sure of with forecasting is it will always be wrong, because you'll never get it spot on. Have you ever got a forecast absolutely spot on? No.
Like weather forecasters, we try and predict things within error bands. But like weather forecasters, we don't predict the precise temperature on a given day or the precise rainfall on a given day.
So we never plan our picnics around the weather forecast, but we do certainly plan our public expenditure around the OBR forecasting. And with that in mind, I just wonder, and I'm not trying to be difficult here, but you are extremely predominantly male and from the city and from the Treasury. Do you think that forecasting would benefit from having a more diverse range of people involved in making OBR forecasting analysis, in particular perhaps people who are very often deciding on the household budget, such as women?
I do. I think forecasting always benefits from taking in an array of perspectives and avoiding groupthink. I'm pleased to say in the OBR we've made a lot of progress in terms of the gender balance of our staff. You're right that the 3 of us are male, but if you look at the composition of our staff, it is close to parity and has been getting closer over time. On our board, we have a mix of genders. On our senior leadership team, we do as well. But we are
always... You don't really do. You've got one woman on your advisory board. I googled it earlier because I was amazed that the 3 of you are men, and you've got one woman who does audit on your advisory board.
Oh, well, she provides a lot of advice and input to us, but there are only 5 people on our board in general. But I agree, there is more work to be done in the OBR to improve gender diversity at all levels.
But it's not gender diversity, is it? It's difference of experience. It's who runs household budgets predominantly? Which gender runs household budgets in the UK? Do you have the answer to that?
I'm sure women play more than their role than men in the UK as they do around the world.
Yeah. And there is, therefore, it's not just about gender diversity, is it? It's about noting the inherent difficulty with forecasting. It's about actually taking views from across different experiences. And in the case of the OBR, you're not taking the experiences of the very often women who are running the household budget. And you are predominantly ex-Treasury civil servants and city financiers, are you not?
I'm afraid I would take issue with that. We do take views from a broad range of stakeholders. Our staff, as I said, is relatively balanced in gender terms. I think is also from a range of both professional backgrounds and ethnic backgrounds. Myself, yes, I worked in the Treasury for much of my career. I also worked abroad in the International Monetary Fund and in other places. And so I think we do our best to both reflect diversity in our staff and in our perspectives. We talk to a very wide range of forecasters when we put our forecasts together. Ultimately, what we need is expertise in forecasting, and that can be hard to find. It can be especially hard to find for the salaries that we pay in the public sector compared to what you can get paid in the city. But we do our best. Our staff are not all drawn from the Treasury by any means. They are drawn from all sorts of different parts of the labour force. What we want above and beyond all is objectivity, and what we want is expertise. And I think we get that as well as providing a pretty good representation in terms of diversity.
So just one last question on that. An advisory board to me is a group of people who, by the nature of their diverse experience, are providing advice. So they neither need to be paid a massive sum, nor do they need to be expert forecasters. They just need to be people who've had different life experiences. And on that definition, your advisory board is not very diverse in gender, in life experience, or would you say that that's not correct?
Well, we take advice from a lot of different sources. Our non-executives, well, there's one man and there's one woman. One has worked in the Treasury and one has not worked in the Treasury. So, and so to the extent that we have somebody we benefit from advice from somebody who's done our jobs in a different context at a different time, but as well as somebody who's looked at the whole system from the outside and judged it. I think we do get a reasonably good set of advice from those two people. In terms of those aren't the only people we rely on for advice. We look across the economics profession, we look across industry. When we've got particular challenges like energy, we ask energy experts, and we look to get as wide a range of views as we can, because there is no single expert on any subject. Okay, thank you. So I've just got a couple of questions on the windfall taxes and the energy profits levy and the electricity generator levy. Your forecasts suggest that the energy profits levy now, with giving a total headline tax rate of 75% of profits, that is quite a significant sum, and obviously that is designed through the autumn statement to be offsettable against investment in the UK. Can you tell us how you've taken into account the potential behaviour change and how you've forecast for behaviour change?
Yes, so the energy profits levy was announced in May and amended in the autumn statement. So this is one of the policy measures that we're able to take on quite a lot of external views on when we're thinking about how companies will respond. In a kind of spreadsheet sense, the investment allowance and the higher tax rate increases the incentive to invest. And so if you were looking at this purely on those grounds, you would expect investment to rise as a result of the package of the whole measure. But the, I'm going to forget the name, the previously known as Oil and Gas UK, which changed its name recently.
Offshore, what's it called? Offshore Energies UK.
No, sorry. The
Oil and Gas Authority?
The government links one.
Oh, okay.
I'm sorry, I've forgotten the new name. But they carried out a survey of what people would do in response. And we were particularly interested in that because our concern was that although on paper it increases the incentive, this is the tax rate being changed and the tax system being kind of changed frequently, and whether that would act as a disincentive. And I think based on a combination of looking at how this should work in theory and looking at the responses we were seeing in practice, we thought that those effects would offset. So we did not change our forecast for the volume of investment in the North Sea as a result of this measure. Basically the view that the kind of uncertainty would offset the investment incentive that comes through the allowance.
Okay, so you think that your conclusion then is that the offshore energy companies will pay the additional tax, but they won't invest but they won't use the offsettable investment allowance in the UK. So they'll just pay it as tax rather than use it to invest.
In net terms, in aggregate. So for some will respond one way, some may be put off by what's happened, and so.
But if you're a company and you're faced with, I can just give you the money in tax, or I can spend the money on growing my business, why would you say I'll just pay the money in tax?
Well, for some will have investment plans in place already. What we've assumed is that those investment plans will not change in aggregate. Now, I'm not saying that for individual companies they won't move. Some will decide to invest somewhere else, or do less because the tax rate is high, and what if it changes again? Type of considerations. So, for some they will be able to offset, all because they have large investment plans, and some will. So the idea, the assumptions we've made are based on the assumption that there will be offsetting effects from those discouraged and those encouraged.
Okay, I would have thought the rational thing to do is to offset right up to the level of the tax that is allowable. That would be the rational thing for a company to do. But anyway, okay. And then in terms of if prices unexpectedly did return to 2021 levels, do you have a view, a forecast on what that would do to tax receipts?
We didn't look at that sensitivity in the EFO this time. We looked at the potential impact of much higher prices, given what we were talking about earlier about how exposed the public finances are via the EPG. We have revised up our forecast for revenues very, very substantially, and so the impact on revenues from this tax, and also more broadly the taxes on the North Sea, would be of the order of several billions, possibly in the tens of billions, if prices were to collapse. Yes.
Okay. Okay.
Is that one last question you want to ask?
Yeah, thank you. So there isn't a similar investment allowance for the electricity generator levy. Does that mean you've costed investment behaviour differently, or have you assumed, like with the offshore energy, that it's just all nets out?
So this one is more complicated, and I feel less confident in what will happen. The thing that we focused on most here was that the generators levy is in some sense more clearly a windfall tax, so it's not just a higher rate on all profits, it is a tax rate that is applied to revenue beyond a certain price, and only for those generators in the renewable sectors that are not covered by the contract for difference schemes. Now, as I understand it, new investment in renewables is almost always covered by contract for difference now. And those contracts still provide the long-term certainty that is that the energy experts we speak to deem to be the most important factor in new investment in renewable generation. So with this one, the assumption is again that it does not affect investment, basically because investment in non-contract for difference renewable capacity, new investment does not go into that sector. So for new investment with the contract for difference scheme, that's where that applies. But as I say, I feel less confident about that one. It was a new measure. There was no, we couldn't follow what surveys and businesses were saying as it was happening.
Okay, thank you. I mean, we've got the Chancellor tomorrow, so we may want to try that sort of line of questioning again. I think in terms of today's session, you've highlighted some of the challenges you faced over the summer and then preparing this forecast, and of course we accept that all forecasts are wrought within uncertainty. I just want to check that there's no one who has a burning question before we leave. I see a couple of burning questions. First, John, who has to leave at 4:30, then Angela. Yeah.
Very briefly, earlier I shared with you certainly my frustration and probably others about the lack of forecasting accuracy and being behind the curve on the inflation issue and so forth. To what extent, you talked about going to the market to base a lot of your forecasts, but the market has often been proved wrong, as I think Danny was highlighting. I mean, to what extent do you do your own research? Like, for example, the inflationary effect of shortened business supply lines and demographics. Do you do any of that, or do you research yourself?
We do when time permits, and with the limited staff complement we have, we do a lot of our own research, and in particular when you have these kind of idiosyncratic shocks. As I said back in July, we did a big report, both on the supply chain issue and about in general is kind of global trade intensity shrinking and countries becoming more self-reliant, what that might do to productivity and growth, as well as what are the risks around energy markets in the near term. So we do our own research, we do our own analysis, we do talk to experts who don't fall under the traditional definition of macroeconomist, but know something about a trend which is driving economic developments like energy price changes, like supply chain effects. So we do look into those where we think that they have macroeconomic relevance or where they're novel and we need to understand.
Okay, thank you.
Thank you. Angela, and then Danny, I think you had a last question.
To ask about the increasing tendency of the government to allow council tax increases to take the strain of particularly paying for social care. And you say on page 34 of your report that you've assumed that the extra flexibility that the government have given local authorities to raise council tax will actually all come through, that they will raise by 5%. Do you check to see whether this has happened in the past, and what are the distributional effects, even were all this money to come through, because it's skewed in terms of the capacity of councils in different areas actually to raise relevant amounts of money in that way. My own area, for example, can't raise nearly the same amounts of money that can be raised in areas where property prices are much higher. When this actually happens, what do you do to take account of the distributional effects as well?
So on the first one, we do look back at how, this is council tax in England. The referendum principles have been 2%, 3%, 3% plus adult social care precept for some years now, and the outturn is typically like very, very, very slightly below the maximum, and so that's what we've assumed again here. We don't look a lot at the distribution of how the revenue comes in and the expenditure needs. It's not something we focus on for the our job of forecasting the overall public finances.
Simply that when that happens, some areas cannot use money they can't raise because they're in a different position than other more affluent areas with more affluent property prices. And therefore there are skewing effects of the way in which that money can actually be used to deal with the need that there is locally, aren't there? That over time are getting greater and greater, but you don't pick any of that up.
Well, I think this is one of those issues that is clearly very important, but it's not core to our job of forecasting the overall public finances.
Again, we've got the Chancellor tomorrow, so and then I think last question goes to Danny.
Yeah. Appreciate it's been a long session, and very much appreciate your patience and time. On page 19 of your outlook, you talk about mortgage rates and the effect on real household disposable income. I'm just concerned that you make the point that impact of higher interest rates on mortgages will be offset by increases in saving rates, even though you think the saving rates are going to decline, I think. With the implication that it's a sort of net neutral effect, but I mean, you also do acknowledge that the change will be unevenly distributed, which indeed you would expect. We're talking about people with mortgages having to pay higher mortgages, other people with savings benefiting. So there might be some net neutral effect in theory, but in practice we've got people with very high mortgage rates to pay. Are you not concerned about the risk of a mortgage crisis given rising rates?
I mean, you're absolutely right. It's very unequal, and most of the savings are disproportionately owned by people who've got higher incomes, probably older, lower mortgages relative to their resources, and younger people will have very little savings and might have a large mortgage relative to their income. And we do factor some of the implications of that for consumption by essentially assuming that the negative hit to people who've got a big mortgage has a bigger downward effect on their consumption than the positive effect on somebody who's got the savings. Is there the potential for real problems in the housing market and large numbers of people falling behind with a mortgage? I'm afraid that potential obviously is there, and there is certainly a risk about that. We use the swap rates to try and work out where the average interest rate is going to go on the stock of mortgages. It goes up for a while. It's slow though, because as you'll know, the predominantly mortgages in the UK now become fixed rate mortgages, so it doesn't feed through to most people's mortgage, higher interest rates, until they remortgage. So it's kind of a slow and gradual increase in the average interest rate on mortgage stock, but for any individual household, it's a big shock probably at the time in which their fixed rate deal runs out. The Bank of England and the Financial Conduct Authority, I should say, have had rules in now, which I'm sure you're very well aware of, for some years now, which say that mortgage lenders have to assess whether or not when they make a new mortgage loan, people could live with a sudden 3% increase in the mortgage rate. And those rules have been there for, several years now. I mean, at least 7 or 8 years, is my recollection. So the majority of large mortgages relative to people's incomes, which have been taken out in the last 7 or so years, in principle, the mortgage lenders have had to assess whether people could live with a sudden 3% increase in interest rates. That 7% increase in interest rates on the mortgage is coming for a very large proportion of people. One hopes that the banks and the building societies had taken pretty seriously what was the new rules of the game and judged whether people could live with a 3% increase. Is there a risk that large numbers of people can't? Yes, I think there is a risk.
Thank you very much, and thank you for your time this afternoon. You've allowed us to sort of probe and scrutinise quite a lot of the assumptions that you've made, and you've acknowledged yourselves, how hard it is to forecast, particularly in these very fast-changing circumstances. I think I noted one potential follow-up, which is if you've got any more information on the Northern Powerhouse rail situation. But other than that, I think that is the end of the session, and so order, I declare that the Treasury Committee session is now over. Thank you.
Has ended.